Hey there, my name's Ben Everingham, and in today's video I'm going to talk about what I learned from meeting Phil Anderson, who wrote that amazing book, The Secret Life of Real Estate and Banking. So for any of you that don't actually know who Phil Anderson is, he's one of my idols. He's probably one of the most interesting people in the property industry globally. So a while ago, about 2 years before the 2008 to 2012 global financial crisis, Phil actually wrote a book, and that book was called The Secret Life of Real Estate and Banking. And that book looked at 250 years worth of property booms and busts in America. And what's really interesting is the booms and busts in the American market have obviously followed the booms and busts in the Australian market and the booms and busts in the European market. So this book looks at all of the history surrounding the stock market crashes, the property market crashes, particularly the American market, which Australia has always lagged about 6 months to a year behind, at least for the last 150 years. Really interesting reading, but Phil's a quirky guy who I absolutely have so much respect for. He wrote this book pre-internet, so his story is absolutely fascinating. And Phil's claim to fame, I suppose, is he's an Australian economist. His family ran a very successful business in Melbourne, then took advantage of the early 90s recession, bought a lot of commercial property at the bottom of that market, and then since then Phil made great money predicting stocks through the dot-com bubble, and since then has been a very active property and share market trader. So really interesting guy, exceptional book. So last night I was lucky enough to finally meet him, and for me it's like meeting, I don't know, like I'd be more excited. I think Ed Sheeran was in Brisbane last night. Love his music. I was more excited to actually go and watch Phil. This guy was exceptional. There was about 120, 130 people in the room. Most of them a lot older than me. The average age was probably 50 to 70 years of age, which felt good because I'm sort of getting onto some of his information a little bit earlier than most people do. If you haven't read his book, The Secret Life of Real Estate and Banking, 100% pick it up. But you know, one of the things that he talked about that we can use as property investors, as share market investors, as business people, as employees, is understanding the timing of the global cycle. So a lot of people will say there's no cycle, you can't control your investments, you can't control the future, we don't know what's going to happen. A lot of people freak out at the wrong times of the market and don't buy, and then get into the market when everybody else is, and you know, that's obviously one of the times to not buy sometimes. So it's like, you know, using logic and history to explain a potential future. And as Phil said last night, the past doesn't always predict the future, but it does give you some little interesting benchmarks to consider for the future. And right now, in terms of where we're at in this 18-year property cycle that Phil explains, is smack bang in the middle. So you know, effectively the cycle works this way. And if you go onto Phil Anderson's website or Port Phillip Publishing's website, you can see this clock that he created, which looks at the 18 to 19 year property cycle globally. And again, America drives that cycle at the moment because it's still the biggest economy in the world. In the 18-year cycle, we generally get 7 years of flat. At the time of recording this video, it's 2018. So you can kind of look back and go, well, it's been pretty red hot in Sydney and Melbourne in particular since about 2011 or 12. We've gone through, you know, 6 to 7 years of the first part of the cycle. And then what generally happens is we go through what they call the mid-cycle slowdown, which is generally where the share market corrects a little bit, interest rates start rising a little bit. The share market, for anyone that follows it and that knows its history, knows that every 3 years for the last 70 years the market has corrected by over 30% per annum. So that's a 30% drop once every 3 years. For anyone that knows their history, every year for the last 100 years or 90 years in the share market, it has dropped by at least 10% per annum and then re-corrected. So a share market drop isn't a bad thing. In fact, it's an amazing thing for people in cash and people that understand the right times to buy. But I'm a property guy, we're going to talk more about that in today's video. So once we get through that 7 years of up, We've got around about 1 to 2 years of the mid-cycle slowdown. Generally, it's when interest rates in America start to rise to curb inflation, and the share market sometimes correct, or at least it has based on history. The correction in the property market is generally minimal. It might go flat for a couple of years, which we're starting to see in Sydney, and I expect to start seeing in Melbourne within the next 12 months. And then we have the second half of the cycle is where stuff really kicks off because people forget the last GFC. You know, a lot of the people that were working in that space and managing people and running businesses are out of the market now. So we go through this 5 to 7 years of upward growth, and it's really, really good to be in property through the mid-cycle slowdown and then through the first 4 years of that upward growth. But there's this particular point in the last 2 years of the cycle before we recorrect and property prices and share prices do drop, which is generally called the winner's curse. And we've all seen that before. People that bought cryptocurrency or Bitcoin at $25,000, now it's worth $5,000. It felt like it was never going to stop. It was easy money. Everybody wanted it. But those people that bought in the last 3 months when it went from 7K to 25K, that's the winner's curse phase of any cycle. And every marketplace in the world has it. And if you get caught in that time, you know, there's serious danger of losing money. And that's the same with property, and that's the same with the share market. So what you do, or what sophisticated investors do, is a couple of years before that, you know, secure their portfolio, de-leverage themselves a little bit, go into cash a little bit, and set themselves up for the biggest buying opportunity of a lifetime, which is could be called the global financial crisis. Some of you might remember it as the recession we had to have. The Great Depression was another one of them. But these are times where property prices can drop by 20% in some countries, up to 70% in some countries. And you know, again, that can be scary for some people. You've always got to remember that by generally the middle point of the cycle, so after the first 7 years after a correction, property prices are already back to all-time highs. Generally the share market's hitting all-time highs, and you can see that in the Australian Stock Exchange at the moment. We just went over 6,000 again. So interesting stuff to consider, interesting stuff to know. I'm not going to talk about it too much because just read the book, The Secret Life of Real Estate and Banking. It'll really give you some perspective. Again, this stuff always doesn't work like clockwork. Sometimes it can be 5 years up, 3 or 4 flat years, 7 years up, and vice versa. And it can be sometimes 2 years really heavily down or 4 years down. So it's not a absolutely do this and nothing else silver bullet strategy for investing, but it does help you begin to understand the right times to buy, the right times to de-risk yourself, and the right times to potentially sell. So really, really interesting stuff. And it kind of is counterintuitive for most people because Australians love a winner. Think about a horse in the Melbourne Cup that everybody knows that has been doing very well, Black Caviar, for example, a few years ago. And we get obsessed with winners. And I've seen the same thing in the last couple of years in Tasmania. Like, seriously, the Tasmanian property market, come on, like, it's got negative population and job growth, but it's gone up by 20 or 30% in the last few years for no other reason but speculation, in my opinion. It's nothing, you know, unless you're living there and it's a beautiful place to live, it's not the best investment market in the world. But it had a 10% year, and history shows us that when a property market grows by 10%, Aussies love backing a winner and they get on that bad boy, and generally that 10% year run lasts for at least 2 to 7 years after that. We've just seen it in Sydney, we've just seen it in Melbourne, we'll see it in Brisbane probably, and Perth again later on in the cycle. But you know, nothing's wrong with getting on a winner when it's just starting, but getting on a winner, like people that are still buying the Sydney property market that don't want to live there right now, after it's just gone through 70 to 80% growth in 6 years, absolutely crazy. And those people that are buying now are already feeling it, the lack of demand in the market, auction clearance rates coming down, property prices in the above $2 million market dropping by 200 or 300K. You know, that's all natural, and that's completely fine. If you bought for $1 million and your property's worth $2 million now, then if the property market does drop there by 10 or 20%, which, you know, I don't expect to happen now, but could happen in the future, you know, it doesn't really matter because you've gone from 2 million to 1.8, but if you look at the last 7 or 8 years, you're still up 800K. It's just the people that buy for 200 or $2 million that expect the property price to stay there that are the ones that are overexposed. And, you know, buying the wrong time of the cycle is never a good thing. And this book will help you create a bit of a framework. It'll help you think a bit differently, and it'll help you think a little bit more strategically as well. So that's the 18-year cycle. In terms of where we're at right now in the cycle, we've just gone through that, you know, first 5 to 6 years. The mid-cycle slowdown apparently is going to come somewhere between 2019 and 2020. Personally, I'm very, very excited about it as an investor because I love to buy when other people, you know, or not as many other people are in the market, as opposed to when everybody's frantically trying to buy and places are selling like that. In the last 12 months in Brisbane, I've personally bought a number of properties and very excited about those, and will continue to purchase properties all the way up through till 2024, and then I might, you know, hang on the sidelines for a little while and just watch things unfold. But you know, that's the cycle. That's where we're at right now, according to Phil Anderson and the conversations that we had last night. In terms of how to take advantage of this and what it really means for us as investors, the number one thing we can do is understand that history has repeated itself for the last 250 years pretty consistently in America. The only thing that stops the cycle repeating or delays the cycle for a few years is generally war. And we've seen that in World War I and World War II. Mainly in the property market. Share markets still go up and down during wars. But, you know, in terms of taking advantage of it, I have very, very specific periods of time where I buy a property, very specific times where I buy shares now. So in terms of the property side of things, I like to buy at the bottom or within the first 2 to 3 years after a GFC. I like to buy in the mid-cycle slowdown to ride that second wave. In terms of stocks, it's pretty much the same. Like the sooner you get in at the bottom, and then after the mid-cycle slowdown, the better. The results were crazy in the data that he was showing me from 100 years of the Australian stock market, 200 years of American data, you know, for properties, as well as the markets in terms of the stock market for the last 100 years over there. If you're not investing and you're thinking that saving your way to financial independence is something that you can do, then you've got another thing coming. Because let's say that this is something that Phil and I talked about last night. Let's say that your average income, you know, you're on $100,000 a year combined right now, and inflation next year is 2%, so you get a 2% pay rise. So next year you're on $102,000. Let's just take a step back and go, well, if I was to buy a, you know, let's call it a $500,000 property, just for easy numbers' sake. Again, I'm nothing prepared here, just winging it. So buy a $500,000 property, that's cost you 50 grand out of your own pocket, and in the next 12 months that property grows by 5% a year. So effectively, your $500,000 property in the next year is worth $525,000. You've now made $25,000 on your $50,000 investment out of your own pocket, and you've got a 50% return on your money. Now, I know there's a lot of people that would challenge the way that I've just done those numbers, but a lot of the people that I'm speaking to now are just getting started, and I don't want to overcomplicate things. So in terms of just beginning to understand the value of using property and using shares to really set yourself up, to set your family up, to set you and your partner up, it's really something that you've got to get your head around and get educated with. That book, The Secret Life of Real Estate and Banking, will really help. It was an absolute pleasure to speak to Phil last night, get a photo with him and listen to him for 3 or 4 hours. It's the last time, unfortunately, he's coming to Australia to speak. But incredible guy, incredible book. If you haven't read it, you're at a serious disadvantage as an investor. So check it out, and, you know, don't use not understanding this stuff as an excuse. It's your opportunity to set yourself up for your life and to get out of full-time work and to become financially independent. I've recorded some other really great videos on YouTube and on my blog, which are like 4 properties to financial independence and what I've learned from buying over $150 million worth of property. So check out some of those videos and start really taking your education to the next level. Really appreciate your time and attention today, and thank you so much. Bye.